Have you ever wondered how central banks manage the economy and set interest rates? It's an intriguing question that weaves a complex web of economic dynamics. Today we're going to unravel this mystery in a simple, easy-to-understand manner. Imagine the economy as a giant machine. It's intricate, interconnected, and needs constant fine-tuning to run smoothly. At the heart of this machine is the central bank, the silent force that keeps the gears turning. It's the job of the central bank to ensure that the machine doesn't run too hot or too cold, but just right. First, let's demystify what a central bank is. It's a nation's primary monetary authority responsible for implementing monetary policy, issuing currency, managing exchange rates, and maintaining the stability of the financial system. It's like a conductor of an orchestra, guiding the symphony of the economy. Monetary policy is one of the primary tools in the central bank's toolkit. It involves manipulating the amount of money in circulation to influence interest rates and either stimulate or slow down the economy. When the economy is sluggish, the central bank can lower interest rates, making borrowing cheaper and encouraging spending. Conversely, if the economy is overheating, the central bank can raise interest rates, making borrowing more expensive and encouraging saving. Another key role of the central bank is to act as a lender of last resort. This means that in times of financial crisis, when commercial banks and other financial institutions face a liquidity crunch, the central bank steps in to provide funds and ensure the stability of the financial system. Now you might be wondering, how does the central bank know when to step in? This is where economic indicators come in. The central bank closely monitors a range of economic data, including inflation, unemployment, and GDP growth. These indicators serve as a barometer of the economy's health, guiding the central bank's decision-making. So, to summarize, central banks play a pivotal role in managing the economy. They do this by setting interest rates, implementing monetary policy, acting as a lender of last resort, and maintaining the overall stability of the financial system. Their actions are guided by economic indicators, which serve as a gauge of the economy's health. Remember, the central bank's ultimate goal is to maintain economic stability and promote sustainable growth, ensuring that the grand machine of the economy runs smoothly. It's a tough job, but someone's got to do it. And that someone is the central bank, quietly orchestrating the symphony of the economy. So, the next time you hear about interest rates changing or a new monetary policy being implemented, think about the central bank, working tirelessly behind the scenes to keep the economy on an even keel. It's a complex task, but as we've seen today, it can be understood with a little bit of insight and clear explanation.